He is a stealth-styled perma-bear who calls the world we live in a horrendous Keynesian monetarist nightmare, but it's a bad dream where you still can make plenty of money, where corrections like the one we just saw create so-called bubblicious buying opportunities. He's Bob Janjuah, the chief market strategist at RBS, usually found in London, but he's here in New York this week and joining us for the hour here on Inside Track. Bob called the massive rally in stocks that started last year, and on April 26th said the market was due for a 10% correction, which is pretty close to what we got. Bob, I am so glad you could be here. Let's start with this because we have to take a quick break. In a couple of minutes, even less, what are you going to buy? What are you going to sell? Stocks. A buy?
Maybe short term, but I think the second half of the year was always going to be difficult.
Okay, euro dollar.
I think the euro's going to parity.
Euro's going to parity. And in the short term?
Short term, I thought we'd have a stronger bounce. I guess maybe today I have to look at it again.
All right. Reconsidering treasuries.
See, ultimately, I think Fed policy is about creating inflation. So long term, I think there's a problem there.
A problem. And yields could be where in 6 months?
Well, if you multiply the money base many-fold, you think of a number, double it.
Really?
Yeah.
All right, we've got to talk more about that. Yeah. And finally, gold on its way back up this morning.
Yeah, look, I think we're in an era of destruction of fiat money. I could easily see $1,500 an ounce this year. Just
before the break, you told us you think the euro is going to go to parity. Yesterday on the phone, when you landed in New York, you and I had a chat, and you said that you thought in the short term it might run up as high as $1.40. This morning, trading under $1.27. Yep. You're reevaluating. Why?
I mean, I think there's a bunch of issues around credibility, and I think also the noise coming out of the ECB around Treasury. And Eric, I sent you a piece which I put out last week where I felt that the position of Axel Weber was also, I think, under compromise here. So I think I was looking for a bounce up towards the 137 level. That was an interesting technical level. I'm not going to rule it out now, but I think ultimately the longer-term trend in the Eurozone is towards parity with the dollar.
How long do you think it takes before we get to parity?
Well, I think the issue here is really Greece, for example, and I think this package was about more than Greece. But ultimately, Greece, I think, is going to have a pretty tough time with the tourist season over the next 3 months. I suspect it's going to struggle to deliver on the objectives on the fiscal tightening. And I think at that point, the credibility of the whole Eurozone project, the ECB, will be put into question again. And I think that may be the trigger for the bigger slide down.
Okay, so what happens? The tourists don't come to Greece as perhaps the Greeks were hoping them to, and the Greeks find it difficult to enforce the austerity measures. Yeah. Where's the trigger? What do we see? What's the catalyst later this year when all of this happens? Yeah. What do we need to look for?
Well, I think really, the Greeks have a pledge to achieve certain levels of deficit cut and austerity. We have now, I think, officials, bureaucrats from the EU and the IMF in Greece. They'll be watching these numbers. And I think there's a very strong undercurrent, I think this is quite obvious, of mistrust in Germany, what's going on. And I think any sign of slippage will be front-page headlines in Germany. And I think Mrs. Merkel will then be under intense pressure.
An intolerable position, as it were.
I think so. I mean, what's interesting is this package was jammed out literally just after the vote in North Rhine-Westphalia. Now, I think if Greece asks for money in breach of covenants, let's put it that way, the ability of Mrs. Merkel to get anything more through, I think, is extremely limited.
All right, you said just a moment ago that this was about more than Greece. What was it that ultimately drove the EU and the IMF to put together this $1 trillion rescue package over the weekend? Was it the market declines we saw last week, or perhaps something else, or a combination of the two?
I think it's a combo. I think the key for me, and we've been pretty consistent in this, is Greece. I think people can argue all day long about willingness and ability. I would tend to believe that more people have a lot more doubt around Greece's willingness and ability. I think Portugal is a sort of unfortunate victim here. The line in the sand was always Spain. And I think once it looked as though it was spreading to Spain, I think Italy, is a red herring. I'm not at all concerned about Italy relative to the concerns around Greece and Portugal. But I think Spain was a line in the sand. And I think the Eurozone officials felt that they had to do something this weekend.
All right. When you're investing, and I can't really speak from personal experience, but so much of it, we like to believe, come down to fundamentals and technicals. Politics really seems to be the X factor here. How do you game out the European political system as you look ahead? How do you know when to buy, when to sell?
I think the starting point, first of all, I want to go back a little bit. 2008 was the year the private sector essentially failed. 2009 was the free pass where we transferred that risk onto the public sector's balance sheet around the world. 2010 was always going to be the year where the sovereign issue was going to play out. I think the UK and the US will come back and talk about that going forward. But I think in Europe, I think your starting point has to be that the politics is dysfunctional. You have 20-plus governments that you have to get in a room and organised here around single issues. And really, I think the issue, oversimplifying, but Northern Europe, Southern Europe, the tensions are there. The only way, I think, to make this whole Eurozone project credible is if you do sort of move forward to a federal Europe. But this is going to require a huge transfer of wealth from the north to the south. I'm not sure whether the people of the north, and Germany's the key, are willing to do this.
Earlier in the show, we were talking about the mess in Europe. Francine was just walking us through the latest developments there. Let's talk about the U.S. for a moment. Sure. You're big about picking levels on the S&P 500. Sure. Let's see where we were at the close yesterday, 1159.73. Yeah. Where do you think it's going next? Well,
look, starting point, I think fair value for the S&P, based on, I think, a reasonable long-term earnings trend, is 850.
850, yeah. Fair value. Okay, yeah. But that's not where it is now, and it hasn't been there for, what, a year, maybe more?
One thing about fair value is nothing ever trades at fair value for more than a few seconds. Look, I think we've been in recent years, up at nearly 1,600. We've been down at 600. I think the fair value level is 850. I think if the market senses policymakers are over-egging the pudding, for example, on inflation or fiscal irresponsibility, I think we could certainly see those levels, if not lower.
Okay, but you are a pragmatist, so let's talk about how the market is trading now. Over the next, say, 4 to 6 weeks, where might we see it go?
I think the interesting thing here for me really is can we take out 1220 on the S&P? That was a target that I set back in March. We basically hit it. We found it a real struggle to get above that. I think if I was listening to Faber, I think was on here yesterday, Mark Faber, yeah. He was talking about 1180, 1220. I think that is the interesting zone.
Big resistance there.
I think if we can break through that on a 2 or 3 day consecutive basis, 1320 is the next level. If we can't break it, we're back down at 1040, I think, very quickly.
Okay. Now, very quickly, before we move, you talked about over-egging the pudding. Policymakers and politics are playing a key role here. Sure. Is it possible that equities have become a risk-free asset in the sense that whenever the stock market craters, somebody, whether it's here or in Europe or perhaps elsewhere, is going to come in with some kind of rescue package?
Right. Starting point, balance sheets matter. The point here is the balance sheet which has improved the most, which is the most transparent, which you can trust the most, is the corporate sector. The one you can trust the least, I think, is the government, and that's clearly deteriorating. I think the consumer is behind the curve. I like big cap corporates.
I was saying before the break, we've talked about the euro. You say it's going to go to parity. We've talked about stocks. You say there's serious resistance on the S&P 500 at 1220. Time for us to talk about treasuries, because earlier in the show, when I asked you about treasury yields, you said pick a number and double it. Yeah. That's quite a prediction. How long is it? We are right now at 349 on the 10-year Treasury yield, a lot lower than people thought we were going to be at 6 months ago. So all of these apocalyptic predictions for inflation and Treasuries thus far haven't been borne out by reality. We haven't been able to stick a close above a 4% yield. How long is it going to take for that to happen, and how long is it going to take before your predictions for inflation and fiscal profligacy really come true and we see Treasury yields explode?
Sure. I mean, I think the second half of this year was always going to be the key test. I think into midterms and what we get out of midterms here, I think will be critical. I think we end up with a deadlock between Congress and the President. In a funny way, the deficit may then begin to correct itself. And then I think Bernanke will have, I think, the green light to keep rates very low for a very long period of time. I think if we end up in a situation, and I sent you a note that I wrote a couple of weeks back where I essentially threw in the towel. My view was that actually policymakers would not intentionally seek to blow up more bubbles. It seems pretty clear in terms of recent events.
How can they resist?
That they can't resist, right? So I was naive in that call. My colleague Kevin Gaynor was very firm on that view, so I threw in the towel. I think the issue now is actually, in terms of CPI and the traditional measures of inflation, I think the Fed's having an issue there, trying to create inflation. I don't think that's necessarily a good thing, but I think beyond that, I think into the second half of this year and the early part of next year, we may be repeating the mistakes of 04-05, and we may be overestimating the amount of slack, both in terms of capital and labour, that exists in this economy.
Bob, with about 30 seconds to go, and I wish we had more time, at the end of the day, do you still sort of have this very bearish apocalyptic vision that all of the debt that we're creating, all of the fiat currency problems that we're creating for ourselves are going to end in tears?
I think absolutely, and I think in that environment, the issue is do we take the hit in 1 or 2 years, or do we spread it out over 10 or 20 years? Clearly, the longer term is preferable. In that environment, I think we could be in for a repeat of the late 60s and 70s, where stocks net go nowhere. And we wake up one day and realize that we have to do things differently.
Vicious stagflation. All right, Bob Janjuah, it has been great to have you here, Bob. Please come back and see us again on the Inside Track when you're next in New York. That's Bob Janjuah, Chief Market Strategist at Royal Bank of Scotland.